The AI buildout has officially outrun free cash flow. This week, 3 companies showed you how they intend to cover the gap. Alphabet is covering it with commitments. Broadcom is covering it with somebody else's credit. Intel covered it by printing $20 billion of new stock in a single week. And the largest company in the memo, which is not building any of it, is paying for it anyway, out of gross margin, in the same week it changed CEOs. Somebody always pays. This week, the invoices got itemized. Telltale's Weekend Update. I'm Ava Cabot with Marcus Graham at the Cash Flow Desk. Alphabet on page 1, Broadcom on page 2, Intel on page 3. 3 pages of the cash flow memo, 1 problem. Start with Alphabet, because Alphabet stopped being a cash-generative company this quarter and told you so in writing. AI purchase commitments went from $332 billion at the end of the first quarter to $811 billion by the end of the second, in 1 quarter. Capital expenditure guidance for the full year moved to $195 to $205 billion, and Alphabet said plainly that this takes free cash flow negative. And in the same week, the world found out that Berkshire Hathaway spent the quarter buying it, lifting its stake 83% to nearly 106 million shares, about $38 billion, now a top 3 Berkshire holding. Marcus, what does Buffett see that the free cash flow line doesn't?
Alphabet stopped being a cash machine on purpose, and that's a defensible thing to do once. The memo has CapEx running about $132 billion trailing 12 months, against roughly $56 billion of trailing free cash flow. Then they guided CapEx to $195 to $205 for the year. When you spend at that rate, free cash flow goes negative, and that's the cost of the build, not a flag, which means the multiple isn't the right frame on this name right now. What actually prices Alphabet is whether that commitment book converts into revenue that clears the depreciation it just bought. I'd hold that read until the December quarter shows an operating margin with the new asset base in it.
There is one more line in Alphabet's filings worth sitting with. More than 70% of net income last quarter came from investments in other companies, largely Elon Musk's SpaceX. Alphabet disclosed a 7.2% stake in SpaceX Class A stock, 551 million shares across Alphabet, XXVI Holdings, and Google. The search company's earnings quality this quarter is a rocket company. Now Broadcom, which had the opposite kind of week. The numbers were excellent and the stock fell anyway. AI revenue guidance for 2026 of $56 billion, up 180%. Quarterly revenue of $22 billion, up 48%. Earnings of $244 against $240 consensus. AI semiconductor revenue alone hit almost $11 billion in the quarter, up 143%. The stock finished down nearly 5%.
Broadcom's problem isn't demand, it's who funds the customer. Bank of America didn't cut the revenue line, it cut the credit. Analyst Tom Curcarudo put the financing requirement behind that chip build-out at $370 billion and downgraded on XPU credit risk. The memo has Broadcom at about 54 times trailing free cash flow on $36 billion of trailing FCF. That is a price that assumes every one of those customers can pay for what they ordered. The disclosure I'd watch next print is customer concentration, not the revenue guide.
The order book is only as good as the balance sheet on the other end of it. Which brings us to Intel, which did not wait for anybody else's balance sheet. Intel announced a $15 billion common stock offering and then upsized it to $20 billion at $95 a share to fund AI capacity. Marcus, what does that raise tell you about Intel's own cash flow?
That management doesn't think it has any. $20 billion of equity against about $4 billion of trailing free cash flow and $12 billion of trailing CapEx. Everything this company generates in a year, raised in a week and sold to strangers, and it still doesn't cover the spend. At that free cash flow level, the multiple is noise, so don't use it. What decides this is whether the foundry customers behind the raise are contracted or hoped for, and Intel hasn't told you which.
Apple is the other name on page 1. And Apple is the one company in this conversation that could write the check for all of it and has decided not to. Tim Cook steps down as chief executive on September 1st. John Ternus takes the job. Cook becomes executive chairman. 25 years, and the handoff lands in the middle of a quarter that split cleanly down the middle. Revenue of $109 billion, up 16%, earnings per share up 29%, and the stock down 5%.
Apple is funding the AI era by declining to participate in it, and the cash flow statement has never looked better for it. The memo has Apple at about 32 times trailing free cash flow, a 3% free cash flow yield on $137 billion of trailing free cash flow. That is a business getting better at turning revenue into cash, while the story around it gets worse. The quarter is fine. The guide is where the argument is.
And the guide is where it went wrong. Apple told the street to expect 9 to 11% revenue growth in the September quarter, against consensus above 12. Gross margin is guided to slip to 47 to 48%, from roughly 50 in June. Jefferies had already cut the stock to a sell equivalent rating 4 days earlier, taking its target to 264 from 286, on supply chain checks indicating the all-glass iPhone has been canceled.
Here is the comparison the headlines missed. Apple spent about $10 billion on capital expenditure over the last 12 months and $82 billion buying back its own stock. Alphabet, same page of the memo, same end market, spent $132 billion on capex over the same window. One of them is buying capacity, the other is buying scarcity in its own shares. Both are coherent strategies, and we find out which one was right somewhere around the end of the decade.
2 philosophies, 1 page. Marcus on the margin guide specifically, cost or mix?
I'd weight it as cost. 47 to 48% against roughly 50 in June is a guided step down, not a modeled one. Call it 70-30 that this is component cost and it persists into next year rather than a one-product build expense that washes out. The December print is the test.
So the new chief executive's first job is finding the margin his predecessor just gave away.
And that's the real succession risk, which is timing rather than strategy. Ternus is a hardware engineer inheriting a company whose next 4 quarters get decided by component prices and a single launch, with the market already paying about 33 times forward earnings for the handoff. Apple's trailing revenue is $467 billion, so the margin step they just guided is somewhere around $9 billion a year of gross profit that has to come from somewhere else. I'd wait for the December print for real evidence, not the keynote.
Which is September 9th, when Apple is expected to show the iPhone 18 Pro, the Pro Max, and an all-new foldable, 8 days after Ternus takes the chair. Cook spent his final weeks as CEO opening a manufacturing plant in Houston alongside Commerce Secretary Howard Lutnick, a supply chain executive closing out a supply chain career, handing the company to another supply chain executive at the exact moment the binding constraint stopped being supply and started being what supply costs. Rapid fire. Somebody finally put a price on PayPal. Stripe and the private equity firm Advent International are in talks to buy it at $60.50 a share. The stock closed almost 2% above the bid, which is the market's way of saying the first number is not the last number. Going in, the memo had PayPal at 7.5 times trailing free cash flow at a 13% free cash flow yield on nearly $7 billion of trailing free cash flow. And in the same week, PayPal said it will cut roughly 20% of its workforce, about 4,800 people, over the next few years, while raising full-year adjusted earnings guidance to about $5.38 a share. A 13% yield and a 20% headcount cut is what a company looks like once it has quietly agreed the growth story is over and the cash is the story. Eli Lilly put up a quarter that makes the rest of large-cap healthcare look sedentary. Second quarter revenue of about $23 billion, up 48%, beating consensus by 11%, with adjusted earnings of $8.38 against $6.58 expected. Full-year earnings guidance went up nearly $3 at the midpoint, to $35.50 to $36.50. The oral GLP-1, Foundayo, took its first European approval in the UK, with weekly prescriptions at a new high of about 29,000, and Lilly sued 6 companies over black market sales of retatrutide, the obesity drug it has not launched yet. Suing counterfeiters of a product you cannot buy is its own kind of demand data. Lilly also agreed to acquire 3 vaccine biotechs, Curevo, Limitech, and Vaccine Company, for up to $3.8 billion. That is a company spending obesity money on vaccines, which is what you do when you have more cash than pipeline. The memo has Lilly at 55 times trailing free cash flow on $21 billion of trailing FCF. And Snowflake is being priced as though the AI agent story is already settled. Oppenheimer took its target to $400 from $295, citing consumption trends and adoption of the company's coding agent. Snowflake raised full-year guidance to about $7.65 billion on quarterly revenue of $1.4 billion, up 33%. The memo has Snowflake at 95 times trailing free cash flow on about $1.2 billion of trailing FCF. 95 times. At that multiple, the guidance is not a data point, it is the whole investment case. And Microsoft told you what the build-out costs in a single line item. Net losses on its OpenAI investment reduced Microsoft's net income by $3.1 billion and diluted earnings per share by 41 cents. That is Microsoft's own investor relations disclosure, not somebody's estimate. JP Morgan raised its price target to $625 from $550 in the same week, on 24 times projected fiscal 2028 earnings. The memo has Microsoft at 53 times trailing free cash flow, on $70 billion of trailing FCF against $116 billion of trailing capital expenditure. Microsoft is the only name in the memo paying for this build-out twice, once through its own CapEx and once through its partner's income statement. Forward calendar. Home Depot Tuesday, Lowe's and Target Wednesday, Walmart and Deere Thursday. The entire American consumer inside 3 days. And then the print that settles the argument in this whole show. NVIDIA, Wednesday the 26th. We will take that one the weekend before it lands. Broadcom lost 5% finding out those are two separate questions. The build-out has outrun free cash flow, and every name we covered this week is a different answer to who pays. Alphabet pays out of its own cash flow until there isn't any. Broadcom is asking its customers' lenders. Intel asked the equity market and got $20 billion. Microsoft is paying twice and disclosing both. And Apple, which isn't building any of it, is still handing its new CEO 2 points of gross margin. On Wednesday's episode 2633, Hunt, Jason, and Mike took apart NVIDIA's $500 billion third-party financing platform, the supply side of the exact question this show just spent 13 minutes on. Hunt, Jason, and Mike are back Wednesday on episode 2634. Download the memo at telltales.us. 20 pages every week. And send us feedback through the Substack. Every note gets seen. The show is produced entirely with AI tools, and both voices you're hearing are AI generated. The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you. The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase, or a solicitation of an offer to buy any security, nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, express or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.